Welcome. In this video, we'll be going over the best investment strategies for 2023. If you want to enjoy a prosperous financial future, making diversified investments is crucial. If you have not started acquiring securities, now might be the time to start. First up, we have high-yield savings accounts. This type of investment is ideal for investors who want to have a short-term account that is less risky. Also, due to it being less risky, you can easily save your emergency fund or money that you want to access. Banks that offer high-yield savings accounts are FDIC insured. You do not have to worry about losing your initial deposit. This is considered a safe investment, but there is a risk that you can lose purchasing assets due to inflation rates being higher than the account's interest rates. Banks, credit unions, and online lenders offer high-yield savings accounts. It is important to shop around to get the best rates. A high-yield savings account pays you a low interest rate on your account balance. It is a good place to store your cash or emergency fund. With the vast amount of banking options out there, you will find that online bankers will grant higher interest rates. Next up is short-term certificates of deposits. A CD is a good investment for various reasons. It will be an excellent account to hold your money in if you are a retiree who does not need it immediately but wants to gain interest. A CD also works well for investors who do not mind tying up their cash in exchange for gaining interest later on. CD are considered a safe investment for the most part. They can run a risk if lower interest rates are offered after the maturity date and you want to reinvest. It can also be risky if inflation rates rise very high and disturb your purchasing power. Banks and credit unions offer CD accounts. Banks offer these certificate funds at a higher interest rate than a traditional savings account. There are short-term and long-term CD periods. Short-term is usually recommended because inflation rates are always expected to rise, so once the short-term CD matures, you will be able to reinvest your money to keep up with inflation. When opening a CD account, the financial institution you are banking with will pay you interest regularly. Once the account matures, you will get your original principal balance back, plus the amount of interest on that account. One important thing to note about a CD account is that they are time-stamped. This means that you must agree to leave your money in the account for the entire duration until the maturity date. There will be a penalty cost if you decide that you need to withdraw money before the account matures. Next up is short-term government bonds funds. These investment funds are good for beginner investors looking for cash flow. Funds that are invested in government debt securities are considered the safest because the U.S. government backs them. Interest rate risks are higher for long-term bonds rather than short-term bonds. Like any other investment, you can lose money if inflation rates rise above interest rates. You can invest in exchange-traded funds, ETFs, and mutual funds through online lenders. Government bonds funds are mutual funds or ETF that are invested into debt securities by the U.S. government. Government bonds are categorized as low-risk investments even when interest rates rise. Next up is S&P 500 index funds. This security is best for beginner investors who want a small taste of investing in the stock market at a lower risk. It is recommended to hold your position for at least 3 to 5 years to see a return. The S&P 500 is considered less risky because it incorporates pieces of the largest and most prosperous companies in the world. It is still considered a stock, so there is a risk of volatility, and the government does not back it, so you can still lose money with fluctuating rates. However, the S&P 500 has a historical record of a positive rate of return on investment. You can invest in the S&P 500 with any brokerage account that allows you to trade ETF and mutual funds. The S&P 500 index funds are riskier investments in the stock market compared to traditional banking products like high-yield savings accounts and CD. These funds are based on around 500 of the largest American companies, for example, Amazon and Berkshire Hathaway. This specific type of security offers small pieces of diversification amongst the 500 companies. The S&P 500 boasts an annual interest rate of about 10%, even on small contributions. Last but not least, we have dividend stock funds. Dividend stocks are a good investment for those who are looking for a source of income, even if it is small. Short-term and long-term investors are attracted to this method of investing. This type of investment does come with risks. It is important to do some research on company history and good reputation before investing. It would be beneficial to diversify your dividend stock portfolio. You can invest in dividend stocks at any brokerage account that sells ETF and mutual funds in the stock market. Dividend stock funds are portions of a company's profit paid out to shareholders quarterly. With dividend stocks, you can gain money on your investments over a long period, as well as short-term with dividend payouts. And that's it from us here at iFinance. Thanks for watching. Don't forget to like and subscribe for more financial tips and strategies to get you ahead of the game. See you next time.